So Jack, thank you for your time today. You wrote a new book, Oh No, Market Visits. And first of all, why you wrote this book and what are you doing today?
Sure. So I hadn't written a market wizard book for, I guess, well, now it's 9 years before this one, but about 7 years before I started that project. And the previous book I had done, I had focused specifically like on large hedge funds. In fact, it was called Hedge Fund Market Wizards. So this was kind of the opposite end of the spectrum, is focusing only on traders kind of just on their own. Nobody knows they exist, trading from a home office, in some cases making a fortune, and in all cases doing very well. So that seemed like an interesting theme. I also am involved in this company, Fundseeder, a startup, which is a platform for traders. And that's a technology company which has a platform, but the ultimate goal is the investment company side would then use the database to form product, from the traders we found. So in that process, I was coming across some traders who had very, very good records, but again, completely unknown. And so a number of the traders in the book came from that. So those two things came together and were a catalyst. There was actually one final catalyst I would mention. Is the first chapter in the book, arguably the one person that may not fit the title unknown. Well, he was unknown a few years ago, but then he started blogging, not blogging, but he has a blog, but more importantly, he started Twitter and he built up a large following, and that's Peter Brand. So he's not totally unknown because he has that Twitter following, but within the investment community, he's unknown because he doesn't manage money. He just trades his own account. And Peter and I are friends, and I always intended that I kind of regretted that I had not interviewed him at some point for one of the books, because he has a very long record. He has a lot of wisdom about the markets. And, I said, if I'm going to do another book, I will put him in it. And so he was at the time in Colorado, which is where I live, a couple of hours away. And I thought, well, and then he told me he was going to be moving in a couple of months. So that was actually the physical catalyst. I figured I might as well interview him before he moves, since I intended to put him in the book. So that got the book started. As it ended up, by the time I got around to interviewing him, he had already moved. But that's another story.
Yes, my first question is, what is the criteria for you that you say this is an unknown market visit?
What is the what about unknown market visits?
Criteria, like how performance, what I need to accomplish in trading to become an unknown market visit.
But you mean, what did I use to pick who would be in the book? Is that the gist of the question? Yes. So, well, of course, part of it goes to the title. I wasn't looking at any hedge funds or well-known managers. That's to begin. But as far as the people I would pick, I wanted to see one or two things. Either they had started with a small stake and built it up into a fortune, or they had extraordinarily good return to risk over a decade plus. Like, so that was what I was basically looking for. One of those two.
What are the 3 top lessons that you learned from the unknown market visits?
Well, I think in the last chapter I probably have like about somewhere between 40 and 50 of them. Some of the things, certainly overlap with other market wizard books, because certain things are basically just true. But in this particular, one thing, maybe one of the most important lessons that might be of interest to, not only lessons, but I guess insights that might be of interest to traders worldwide is it's still possible. So I'd gone into the project thinking I would never find traders as anywhere of the caliber of the traders I had in the first Market Wizards book, where I had people like Kovner and Marcus and Paul Tudor Jones, and in those cases when I was interviewing them, they had records of like triple-digit returns for extended periods. And I kind of thought that, you can't do that anymore in today's world. There's just been too much computerization. There's too many professional traders. It's just not, you don't have this giant trends that you had in the early days of trend following before computers became widespread. So for many reasons, I thought you could get good records, you get people who beat the indexes, but I wasn't going to find people spectacular, because I was wrong on that. And so some of these traders arguably are maybe better even than the traders I had in the first book. And certainly among the best I've ever interviewed. So the interesting thing is, despite this enormous computer, remember, first Market Wizards book was written about people who had traded in pre-PC almost, let alone now where PCs are, everybody has a PC with power, and you have supercomputer power, you have firms with 100 PhDs in math, working and stuff like that. So despite all those massive changes, it's still possible for the individual trader to perform spectacularly well. So that's an insight that comes very much from this book. And then there's lots of the basic lessons. A lot of traders in this book, in particular in this book, were super diligent about keeping very, very specific, precise, detailed records of everything they did. They would log all their trades, the reasons for it, all the decisions they made, how it turned out. Literally, I traders bringing out binders, thousands of pages, of their notes, which they not only wrote but also reviewed. And one trader, for example, I remember, shows me a spreadsheet, and it's not the interesting thing about the spreadsheet. It wasn't only a matter about what kind of definitional things about the trade, but also emotional things. What was his mood? Did he make these type of emotional mistakes? And he would have these columns for 25 entries, and he would check off any that applied, and then he would go back at the end of the week and see if he had some emotional weakness that was coming up. So he had this type of detailed analysis, not only about markets, but about introspective evaluation of their psychology. So I saw that in quite a number of traders in this book, to a really high detail. The theme of learning from mistakes was very big and came up in multiple interviews. So there's lots of, and many, many more lessons, but those are some of the ones that were particular.
What do you think are the biggest mistakes to do as a trader?
Well, the biggest mistake is probably a lack of a good money management plan, or a lack of sufficient understanding and appreciation that money management isn't an adjunct to trading. It's everything about success in trading. So unless you have money management, you're not going to succeed. You're not going to succeed in trading. So I had traders, let's say they might superficially look like they're taking big risks, and they might look like they're taking really large positions, but embedded in that is super strong discipline. So a couple of traders would take very large positions with market events, like a central bank announcement. They would be highly prepared. They would know how to react under every type of circumstance. They'd have the orders prepared. They'd have everything planned out. But and they would then put in an order that would look like, hey, this guy is reckless. He's not using money management. It's too large. But the thing is, they had super discipline, and if they were wrong, they were out in less than a minute. So unless the market responded exactly the way they thought it was going to respond, they'd be out of the trade. So the types of approach they were using worked great for them. But if somebody didn't have absolutely strict risk management and discipline to carry it out, they would blow up. So even the traders that looked like they were being kind of a bit extreme and not using risk management were using risk management to to a very high extent. So that is kind of a thing that amateur traders don't appreciate. They want to come up with lessons of discover some secret about markets, some way of analyzing markets that's never been done, and they're going to be brilliant and all that. Well, that's all fine and good if you need a methodology, but they fail to appreciate that the dull topic of money management is essential to making it work.
And we say we must treat like a real business.
Yes. Yeah, sure. I mean, you could draw that analogy because you're not going to succeed in business if you go in and you start spending money left and right on all these ideas without any plan of how much money you have to spend and what your budget is and where the revenue is going to come from. So in that sense, yeah, the dull part about doing all that planning and having the budget all worked out, that may not be the exciting stuff in a business, but that's what will determine that's essential to being successful. So there is an analogy there to trading.
What do you think, how much money needs a person to start with trading?
Well, there are people in this book that started with, one person literally started with a few $1,000s, and he built it up into hundreds of millions. So, that's possible, but that's a story that's like a one in a 100 million story. Okay, that's just not. People shouldn't expect that. It's hard, like I said, so it is possible. So, other traders started with amounts that were under 100,000. That's more feasible, like $100,000 or something like that. But you could start with something like 25 and trade small. It will take a long time, even if you're good, because you're starting from a small base. But as long as you've got a methodology and you've got, the risk management, you're not trading too large. Like, so, you could, if you're trading stocks, you could just, if 100 shares is too much, you get 10 shares. So literally you could do it with less money if you have the methodology and the risk control.
Okay. How do you think we can create our own strategy to become successful as a trader? Like, what can we read today to create our own strategy?
In terms of like how long it should take to become. One of the traders I interviewed, Brandt, says he thinks it takes a minimum of 3 to 5 years. I think that's a reasonable assessment. I mean, there are people who are successful from the very beginning, but that's unusual. It's more realistic to think it's going to take several years, and then there's no guarantee. But even for successful traders, it takes several years to get to the point where there's a developed methodology and process.
Change our emotional state again to say, okay, this was a mistake, and how you can cut the loss.
Well,
not easy to lose.
Well, the emotional side is there are definite ways to control it. In almost all cases, emotions are negative because emotions tap into our sort of evolutionary instincts, and those evolutionary instincts were not designed for trading; they were designed for survival, and they don't work well to make trading decisions, as has been well documented by lots of behavioral economists and famously by Trotsky and Kahneman, and but certainly many others. So getting emotions out of trading, there's one exception in the book, but for most people would be a good thing, and there are ways to do it. one, the more you have planned out, the less room there is for emotion. So if you've got a very specific strategy and methodology and risk management, then there's less room, and you discipline to follow them, then you don't let emotions get into it. You just follow the process. Now, there's also things that you can do that I'll give you what I think is one of the most helpful things to get rid of emotion. It's what I do myself is if I put on a trade, I didn't always do this, and to my regret, I didn't always do this. If I ever lapse from this, I end up regretting it. But whenever I put on a trade, I almost always will put in a stop at the same time, unless I consider it an investment. I'm going to hold it for multiple years on some sort of theme, I decided a while ago to buy some gold. I figured I should have some gold, so I have gold futures, but I don't treat it the same as other positions, just because I think of it as, well, part of my assets I'll have in gold. It's not a trading position. That's an example of an exception. Whether that's right or wrong is irrelevant, but that's what an exception is. But for almost all cases, I'll put in a stop, good till cancel stop, at the same time, along with the order. So I'll buy something, say buy X, Y, Z at the market with a stop at 25.60, good till canceled. And so I know what my word. First, I don't have to worry. I don't have to make a decision after I'm in. Oh, what do I do now? I will, if the market goes my way, raise that stop. But that's easy to do because you're just reducing your risk or locking in profits. So that's easy. That's not a hard decision. But if it goes against me, I'm not sitting there thinking, oh, do I give it some more room? What do I do now? I've already made that decision. And many people made this point, but Bruce Kufner was the first. And he said that so whenever he puts on a position, I know where I'll get out before I get in. And his point was that's at that point, before you put on the trade, it's the only time when you have objectivity. Once you put on a trade, you lose the objectivity. So why not make the decision ahead of time? So that's a great way to get emotions out of trading. Just that one simple step of deciding on a stop when you put on the trade.
It is true. I think people can't follow easy rules. Like they think always the rules are not to, they want always change something. Like these rules are not working anymore. And this is the reason I think why people are failing. It is true
You mean
that people can't follow rules easy?
Yeah, well, I think that's generally true. I mean, it's certainly true if they haven't devised the rules. I mean, it's the reason why I think I have no idea what percent of systems that are sold out there have any value. There may be a lot of them don't, but I would say that even if 90% of the systems out there, or if there were systems out there that really did work and people bought them, I would say even if the system itself underlying was good over the long term, 95% of the people are going to lose money because they're going to just override the system. They're going to get out. They're going to panic at the wrong time. They're going to do. I can think of one interview I did for Hedge for Market Wizards with Joel Greenblatt, and he talked about how he had the site he put out. He wrote this book like The Simple Formula that beats the market or something just a basic fundamental analysis type thing, a value investing thing. And he put it out there, and he had a site that provided a list of trades. And he said they ran this experiment. They gave people who were on the site the option of just picking their own trades and following it for free, not doing, or they could have it professionally managed. And then he compared the results after a few years. And it turns out that even though the stocks as a group, when they were managed, made some decent return, the people who did their own thing, ended up flat or not making or losing. And I asked him, well, what was the difference? And he said, well, the major difference is they tended to avoid the trades that were painful, that were difficult. And those ended up being the best trades. So the trades that people say, oh, I can't buy this. There's so much bad news out there. And, how can I buy this thing? And those are the stocks. And then people convince themselves they're being conservative by not taking this dangerous trade. Those were the trades that worked the best. So people not following rules really, usually, those type of things end up being detrimental. But markets change, and you have to be flexible enough to change your own rules if what you're doing is not working. So there's a chapter in this book, the only systematic trader, Marston Parker, who, if he hadn't changed his systems repeatedly along his career, he would have blown up. And I remember sitting with him, and he was a software guy. He got into trading because he was a software developer. So he got his own software programs for writing systems and displaying them graphically and everything. So he's developed hundreds of systems in his career, and he can bring up any of them on a screen and show not only what they did when he was trading, but what they would have done up to this point in time. So in his early career, he had been very successful, and the systems he was using started for the first time generating losses, and he abandoned them. So I asked him, well, out of curiosity, do you follow what happened? And I was like, so he said, let me bring it up. And he brought up the chart. And it was like, I'm in Colorado, and out my window, I can see a mountain, Bear Mountain, and a Bear Peak, I should say. And Bear Peak looks like this. It comes to like in the line, and I've been up there a number of times. It comes to a little circumference, just a little bigger than a human. You can get up there and scramble up to the point. And his chart, his systems look like that. It's sort of like this for a number of years. And after they stopped working, they just went straight down. They never worked again. It was amazing. So you have to be able to be flexible enough to realize that what worked once may stop working.
Yes, thank you very much. It is very true that you must adapt like what the current environment says, like maybe political or I don't know, interest rates. Otherwise, everything is changing every day.
Yeah. So could you rephrase the question? I'm sorry. I'm not sure what the question is.
I must. Okay. I said in today's environments, always is changing a lot faster. You must change the system maybe often.
Well, things are changing much more quickly, and things have changed a lot. But as I mentioned earlier, despite all those changes, there's still paths to extreme success. They're not easy to find any more than they were 40 years ago. But all these changes have not removed the opportunity to be successful in markets.
Yes, I think when you can follow the rules and put the emotional outside from the trades, you can make money.
Yeah, it's not quite that easy. I mean, the essentials of it, to boil them down, is you either...
Yes, because people are emotional. That's the hard part.
Oh, yeah, but that can be fixed, as we discussed. So that could be fixed. You need to, though, come up with a methodology that has an edge. And that's not as easy necessarily as it sounds. There's lots of, to paraphrase myself from one of my books, I said something like, a million ways to make money in the markets, but unfortunately, they're all hard to find. That's essential. You have to have some sort of edge. There's a million different ways to do it, but you have to. So if you have an edge and you combine it with money management and the emotional discipline to apply it, then you can still succeed. And I mean, not everybody's going to be a market wizard, but there's nothing wrong with being that profitable. So that's a reasonable goal in itself, just to be able to pull some money out of the markets is fine. Not everybody has to be a market wizard, but you still need to have an edge in money management.
You spoke about Tudor Jones at the first of the interview, and do you know more about his strategies, what he used?
Oh, which person?
Tudor Jones.
Oh, Paul Tudor Jones. Yeah, that was a long time ago. And when I interviewed Paul, we're talking now 88. So, 19. So that's a very long time ago. At that time, he was very much. This is before, I guess, he may have had his company Tudor Corp, but it was small compared to what it eventually became. And he would sit in his office and trade very aggressively. And I'm sure he changed over the years, particularly as his company grew. And he went from managing hundreds of millions to tens of billions. So I'm sure he got much more diversified and all that. But there's some basic principles that he had in that interview, which I guess he probably would still maintain, and that is this idea of course, great respect for risk management, but also he said he looks like at every position, reevaluates it every day. They said if he wasn't in a position, would he still be in it today? So you can't just say, well, I've had it, it's okay, I'll stay with it. This idea of treating every position that he has as if it was a new position, would he still put it on? That's kind of one thing I can remember about that interview that was unique to his advice, which I don't recall anybody else saying as a particular, a lot of people overlap in their advice, but a lot of people have things that are individual to them. And in this case, that's one thing I recall even many decades afterward that he had emphasized.
Can we say that risk management is the very most important thing in trading? Like
Yes.
When you don't have risk management, you never will make money.
Yeah, you can make money, but you won't keep it.
Yes, like no profits.
Yes, you can make money, but you won't keep it. So there's lots of traders who maybe had skill, either their instinctive skills trading or they had a system they developed or whatever that worked and ended up kind of blowing out because they didn't have the risk management. So just having a good methodology or just being a skilled trader is not enough. I can think without mentioning any names, the famous trader wrote a book about trading, and I didn't interview him. And by everybody, and I've met a number of people who knew him personally or worked for him, and they all considered him brilliant and a great trader. But he blew up a couple of times because apparently he just took too much risk at certain points in time. The famous, Jesse Livermore, who is the protagonist in Reminiscence of a Stock Operator, not that he didn't write the book, but the person wrote about him. The book is filled with enormously good advice. Now, obviously, somebody was a great trader, but ultimately he made and lost fortunes a number of times, probably because he was too aggressive and didn't have risk management. So even the greatest traders can end up losing if they don't have risk management.
Thank you very much for the book.
Sure.
It's a really, really great book, I think, to start to read. And Jack, I thank you for your time today. You spoke about your amazing book, and I wish you have a nice day, and thank you very much.
Okay, thank you very much.